Could the interest rate rising cycle finally be over? The fallout from the federal budget has been significant right across our market, and auctions continue to splutter. But this is the real data you actually need to know. G'day there, folks. It is Matt Hayson here, breaking down the reality of what's happening on the ground of Sydney's property market. What will the RBA's next move be with interest rates? Well, over the past week, we have seen two critical pieces of data land that have the trading markets pushing back on the chance of another rate rise until much later this year, and even some are suggesting now that the rate rising cycle is officially over. Let's start with unemployment. Late last week, the latest ABS numbers showed that a shock jump in unemployment rate hitting 4.5%, being the highest level that we've seen in more than 4 years. That means 33,000 Australians have just joined the jobless queue in April alone. On top of that, CBA boss Matt Hayson has just warned that we will see further job losses coming down the line through AI disruption. This softening in the labour market is a massive reason for the RBA to pause, and the bond markets have immediately dialed back their rate rise bets because of it. Then we had the second surprise this week, showing that inflation data, things are stable, if not modestly easing. Now, headline inflation, that fell 4.6 down to 4.2, which is great news, even though the Middle East conflict is still pushing up prices beyond the Bowser. Now, the RBA's preferred measure, which is trim mean inflation, that did nudge up. That went from 3.3 to 3.4%. So, while productivity is in decline, the RBA is stuck in a very delicate balancing act, with the immediate pressure, though, to hike interest rates has definitely cooled. But we aren't out of the woods yet, with leading economist Warren Hogan, who has been incredibly accurate with his forecasting, is defying the consensus. This week, he told the RBA to get on with it and lift rates at the June meeting, arguing inflation isn't under control, and the trading markets, though, they strongly disagree with him. But from where I sit, if we get another rate increase on top of an already easing property market, the consequences, well, they could be dire. However, if the RBA does give us a pause until August or even September, that breathing room could really assist the market that is currently running on very fragile buyer sentiment. So, what do you think? Is the RBA done? Or do you think Warren Hogan is right and we've got more hikes coming? Let me know in the comments. The fallout from the federal budget has continued to escalate over the past week, and I can tell you on the streets we have been absolutely inundated by people across all political leanings, and the general consensus is some of genuine anger, frustration, and a real sense of worry about where this country is heading. Business ambition in Australia has been completely smashed. Who in their right mind wants to risk their savings and then go out there and have a crack at life when the government sits there as your 50% silent partner? They take no risk, but there they are with their hand out. And it's not just business owners either. It's these young entrepreneurs looking to invest in either shares and get their money working for them. The Business Council of Australia this week is united, demanding that Labor limit these capital gains tax changes strictly to property. But Labor is doubling down and rushing to legislate these massive tax shifts anyway. So, what does this actually mean on the ground? Well, our team has had countless conversations this week with people looking to plough more funds directly into their principal place of residence, which is now officially the last tax-free haven that we have left. Meanwhile, we're also talking to mum and dad property investors through the course of this week, many who own a single investment property. Even though they do have the grandfathered rules, many are looking at their asset and it's only returning a 2 to 3% yield. And that is well below inflation, meaning they are effectively holding a loss-making asset. Now, it's been that way for years and for many investors, but the reality is it hardly ever gets reviewed or reported in the media. Land tax, it is exorbitant. And as this current market starts to sharply correct, I'll be very interested to see how quickly the Valuer General starts dropping land values to reflect reality. Now, I'm going to have a stab in the dark here, and I suggest that they won't even do that, and many investors are probably looking at a rise in their land values despite this market correction. Now, let's look at what's actually happening around the grounds in the Sydney property market this week. We've just hit week 9 of the auction market, sitting stubbornly in the 30% bracket. While it did improve from last week's horrendous 31% outcome, we are still sitting at a very weak 36.51% clearance rate. Now, I was pleased to see Channel 9 finally using the SQM research data this week. The mainstream media are always relying on the incomplete auction data reporting that keeps the Sydney clearance rate looking artificially high in the 50 to 60% bracket, which is just wrong. So let's break down the real numbers from last week's auction market. There were 1,123 auctions scheduled across Sydney. Now, only 193 of these properties sold under the hammer. That means just 17% of every auction booked in Sydney last week actually sold at auction. Meanwhile, 469 properties That means 42% of that stock were converted to for sale instead. Now, the narrative around the market is that conditions are tanking, with Morgan Stanley even forecasting that this could be the largest house price correction in 40 years. Mortgage stress is rippling across Sydney, and it's moving straight through the affluent areas of Sydney as well. Here's what we're seeing around on the streets. Properties purchased back in 2021 and 2022 that are being resold right now are largely clocking up losses. That's 5 years of ownership, yet locally we've seen a decline of an average of about 4% from the original purchase price to today's sale price. This is exactly where that data doesn't meet the reality on the road. We're also hearing that many mortgage brokers have completely flipped the script this week. For years, the standard practice was to buy first and then sell. Now brokers are strongly advising their clients to sell first and then buy. At the same time, buyers agents are reporting that their client base has paused. Many have shelved their moving plans entirely, and investors, well, they have completely pulled back out of the market. Buyers are continuing to front load today's risk and future interest rate concerns directly into their offers today, and that gap between buyers and sellers remains incredibly wide, and that's where our daily work is being spent right now, finding that trading line to bring deals together. But look, we're still firm believers that if you have the capacity to do it, a correcting market like this remains a very good window to upgrade your home. That is exactly what's happening in and around the market this week as we close out May and we move into winter next week as well. But let me tell you, we have sellers right now who are meeting buyer demand, and sales are absolutely being closed. So stay alert, because opportunity remains on high alert. Thanks for watching, and I'll catch you all next week.